HMRC are going to tax you at every point. They tax you when you purchase, they tax you when you sell, they tax you when you make money in your company, they tax you when you withdraw, they tax you when you die, they tax you when you sell an asset.
So what can we do about that to make sure that that tax bill is reduced down heavily?
So straight away, I'm looking at what do they need out of the business personally.
So would you say the best way to do it, I'm not saying to do it, I feel like we've got to be so careful in this podcast as well.
You're going to have to pay some tax unless you're willing to relocate and go to a tax haven overseas. You're going to have to pay some tax unless you're willing to rinse the pot dry and keep reinvesting and keep spending. Paying tax to HMRC every year at the top rate isn't a smart financial decision. So you need to make sure what you're training on social media actually matches what you're submitting to HMRC, because if on the off chance someone did check or look, they're active. So it's a balance of having the right tax strategies to try and reduce tax as much as possible, not bending the rules so you're at risk, and also making sure that you're understanding that you're in the UK tax system, you've got to pay UK taxes. So you've got to balance it all, and you've got to pay what you owe.
What is going on, everyone? Welcome back to the CEOCAST, the number one podcast for showcasing business entrepreneurship. Now we are here today to talk about tax, how we can save money by paying less tax. I think for this podcast, we're probably going to need to overlay some graphs and analysis and data and all that sort of stuff for people to have a visual understanding.
Yeah.
But I think the first question that we should start off with, very, very basic, because I want to make this for someone who's watching, who's just starting out, doesn't know anything about tax, all the way to business owners and how they can reduce tax. Just for people who are watching this right now, why is it they should listen to you about when it comes to reducing tax bills? What is it that you've done for other people? What's been your biggest credential so far?
I'll give you a case study. So we deal with like a mixture of businesses, startups, investors, established businesses, and we essentially do a lot of consultancy that's not just tax advisory work. So we actually look at the business model, we look at the staff setup, the service offerings, the revenue streams, the sales channels, and we essentially audit if it's efficient or not, and if there's any way that we can make that business model leaner, which means essentially less expenses, more profits. So there was a business owner, his revenue was, I believe it was 42-ish million, just over 40 million.
Big numbers.
Big numbers. This director was wealthy, doing around 3 million bottom line, so established business, doing well. And he'd grown the business that quickly that he was just used to what he knew, used to his business. Never had someone look at it with like financial literacy and expertise in mind. And we did a full audit on the business. We broke down each service offering, what the profitability of each service offering was, then looked at how many staff and how much of his overall expenditure related to each of them service offerings. And we found that 24 of his actual service offerings out of 27 were actually unprofitable. So to scale that right back, if he could make that change and just have the free services in his business, he wouldn't need, I think it was 72% of his staff he wouldn't need, because they were operational labour to actually fulfill the over 23 service offerings. He wouldn't need the big office block, which he was paying 12 grand a month for. His marketing campaigns could be solely for the free service offerings.
Yep.
And because it's a closer target demographic, the ROAS, which is return on ad spend, would go up.
Yep.
So his ads would be more profitable. And a load of other expenses in management could be cut back. And he would increase profitability if he solely went for them free service offerings by 1.82 million per year if he made them changes. So less work, operationally less complex, less staff. We could bring in a COO at 250k salary a year to take a load of his responsibilities, so he doesn't have to spend as much time in the business. And you can do all that just by auditing the business, understanding where to make improvements, where the risks are, and you can massively increase enterprise value, massively increase profits. And then we plug in, right, what are the tax strategies for the profits that are actually left to reduce that tax burden as much as possible. So that's just one case study.
So you are the right guy for the purpose of this podcast.
I'd like to think so.
We'll start off with personal income. So what are the tax rates for personal income?
Personal income, so it's going to change whether you're withdrawing money out of a limited company or whether you're employed, for example. But essentially, you have like a basic rate band, it's called.
Yep.
So anywhere from 0 to 12,570 is 0% tax. That's your personal tax-free allowance. That's across employees, business owners, no matter what it is. And then from 12,571 up to 50,270, that's the top of your basic rate band. And that's where you'll pay basic rate tax. If you're an employee, it's 20%. If it's dividends that you're withdrawing out of a company, that's 8.75%. Anything above from there, so 50,271 right up to 125,140. If you're an employee, it's going to be 40%. If you're a business owner withdrawing dividends out of a limited company, it's going to be 33.75%. Anything above there for limited companies withdrawing dividends is 39.35%, and for employees, 45%.
The 39%, what was the limit on that? Up to what? Or was that just...
That's just...
Can you keep going now?
There and
so
onwards.
basically, that's
Correct.
the cap.
That's the cap. That's the highest amount of dividend tax you'll pay.
And what was the personal tax you said?
45% above the 125k.
Mm-hmm.
Yeah.
And to my understanding, so the first basic rate is 0%, yeah? And that's up to 12,570.
Correct.
And then let's just say someone's earning £20,000, then they got to pay 20%. But from my understanding, correct if I'm wrong, obviously you're the accountant here.
Of course.
They pay the 20% on the difference between 12,570 to 20 grand.
Correct.
So roughly 8-ish grand, something like that.
Correct. Yeah, they'd pay 20% on the amount above the personal tax-free allowance.
Yeah.
Then there is NI as well, employees NI, employer NI, etc.
And it would be the same vice versa. So for example, if someone's earning 100 grand, what would they pay tax on that?
So first 12,570 is 0%.
Yep.
Then 12,570 to just over 50k will be 20%.
Yep.
Then 50k to 100k is going to be 40%. That's if you're employed. If you're limited company withdrawing dividends, it's going to be 0, 8.75, 33.75.
So it wouldn't just be straight £40,000 tax write-off.
No.
It would be basically broken down, which means it would be less than £40,000 roughly.
Yeah, a lot less. And some people actually have a misconception that if they get a pay rise from their employer and it pushes them above 50k, that all of a sudden they're going to be worse off because they've got to pay a higher rate of tax on all their income.
Yeah.
That's never the case. It's all based on bandings. So certain incomes, different tax rates depending on what that number is.
So then getting into it, how do people actually save tax? Now, we'll come to the business side of things in a second, but I think there are going to be a lot of people who are employed watching this thinking, right, cool, how can I save tax? Now, for me saying this, I'm not the accountant here once again, but if I was an employee working for someone else on £50,000, there isn't many ways for me to save tax. It is what it is because I've got no expenses, I've got nothing to take away from my tax bill or nothing like that. It's just straight whatever the tax rate is that I've got to pay. Am I correct in saying that? Or
Pretty much. There is some options. So you can do salary sacrifice, so you could invest into a pension, and that would essentially reduce your income level and reduce the amount of tax that you pay. If, for example, you're traveling to multiple different sites across the country and you're required to do that by work and they're not reimbursing you for mileage, then you can claim mileage as an expense, 45 pence a mile. If you're, in some scenarios, cleaning, laundry, if you've got to have a certain uniform, you can claim offsets for that. You can do that either via a tax return or what's called a P87 form. So there is some intricate ways, but nothing like if you're a business owner.
what about contractors?
Contractors, so like self-employed contractors.
Yeah.
So
for example, I've got a friend who's a contractor. He works within the finance department at Jaguar. However, he's contracted from, he's a contractor for Jaguar Land Rover.
skip back a good few years, you used to be able to set up as a limited company and have the company pay you as a contractor into your limited company, giving you all the options that a business owner who's running an organisation has in terms of tax efficiency. HMRC didn't like that because it essentially was just putting a barrier between you and the person who's potentially acting as an employer to you, just labelling it as I'm a contractor, setting up the payment structure as a limited company, and then being tax efficient. So they brought in something called IR35, which essentially stopped that. So IR35 essentially treats the contractor, providing the relationship is contractor to employer, and they deem it to be of similarity, they essentially then put them on an employment scheme regardless.
So what does IR35 actually involve?
IR35 just essentially means that you can't use a limited company as a barrier to change what would usually be a relationship between an employee and an employer for tax efficiency.
It's not like a structure they've put in place. They literally just, stop people from setting up limited companies to do that.
Yeah, it's not a choice. So I'll give an example. Let's say I have an IT consulting firm and you're an IT contractor and you're doing consulting for me. You come to the office every day, you do your hours, but the relationship is set up as a contractor. But really, if you break it down, you're acting as an employee because you're working solely for me. You're doing certain hours that I set, using my equipment, my laptop. So HMRC will go, that person is an employee. Yes, you may pay them as a contractor, but we don't allow that because you are now just being tax efficient, even though really you're an employer to an employee. So we're going to slap you with IR35 and essentially mean that you've got to pay usual taxes as an employee. So it gets quite complex. Now, if you are outside IR35, which means that criteria essentially isn't met for you to be inside, then there's more tax efficiency available for you.
So I know what I'm about to ask right now may be a bit relevant because, HMRC have put a stop to that. But just to understand it, a few years ago when people were doing that and working as contractors, how exactly would they be offsetting their tax bill?
So what they do at that point in time, let's say they're getting paid $5,000 a month, for example, that comes into a limited company, which is essentially a company, like a separate entity. They can then pay themselves a salary from that company of $12,570, which is the tax-free allowance we mentioned. That would get deducted from profits, reducing tax, and that money would be available 0% to the individual. So straight away, $12,570 is down as an expense when really they're only paying themselves.
Okay.
And then they can do things such as buy a company vehicle, run an electric vehicle through the company. Any expenses that they've got relating to their setup, they can run that through the company. So straight away, rather than just paying 20%, 40%, 45%, they now have the option to be able to offset quite a lot of that, make pension contributions, and pay a lot less tax. HMRC don't like that.
I can imagine HMRC don't like a lot of things.
No.
So other than, like I said, we're going to get into the business side of things in a second, but for an employee, I mean, I don't want to make myself sound stupid, but I can't think of any other questions. I feel like it is what it is sort of thing, right? Or
employees are limited massively. They don't have like a tax efficient setup. Like they are an employee. There's tax rates set by the UK tax system, unless you're doing salary sacrifice, which essentially is putting money into a pension or some other scheme and then reducing your income. But that means you're actually giving away income. So you are earning less. Even though you're putting it away for your future, you are essentially earning less. Unless you do that or claim the bits of expenses you can, there's not too much to do, in all honesty.
What about, so I just done a podcast recently, like I was telling you before the podcast started, with a chap named Urban Financer. So what he said to us in the podcast as well was the fact that if you invest and back a startup company, you can claim 30% back of what you invested under your tax bill.
Yeah.
Does that apply for employees as well?
Yeah, for sure.
So if an employee was earning £100,000, decided to put £100,000 to back a startup, then they can claim back £30,000 off their tax bill?
Yeah, so there's loads of different tax relief schemes. So you've got stuff like, this is a little bit more advanced, but you've got VCTs, which is like venture capital trusts, which is essentially backing high risk startups. You've got the SEIS scheme, the EIS scheme, which are essentially schemes that HMRC back to incentivize employees, investors, business owners to invest in higher risk startups, which for HMRC is going to mean they grow and they get more taxes from that business as it grows, and they give you better tax relief for that essentially. So I suppose to summarize, unless you're willing to give money to a cause or an investment or salary sacrifice, you can't save too much
as an employee,
unless you want to actually input your money into some sort of vehicle, whether that's pension or one of these schemes. Whereas as a limited company, there's ways that you can set things up tax efficiently where you don't actually always have to spend your money or give away your money to save.
These things that we just mentioned, they can be done through employment salaries.
Correct.
Okay, fair enough.
Most of them. Some of them there's limitations, but yeah, there is schemes like that available.
Anything else we should know about employees saving tax, or that's pretty much it?
I would say as an employee, you need to always make sure you check your payslip because a lot of people don't and they have incorrect tax codes, which means that they overpay tax and there's issues down the line where HMRC may then want tax back from you. So always check your tax code. Always make sure you're on a workplace pension scheme if you can, because your employer, the usual rates are 5% from the employee, 3% from the employer. So the employer is going to actively contribute to a pension for you. So try and make sure you set up on a workplace pension scheme so you're getting that benefit. Always check your payslip, make sure you're on the right tax code. And then if you have got surplus capital, make sure you're not paying unnecessary tax if you don't need that money. It's just going to sit in your bank, set up a salary sacrifice scheme and actually start to invest, reduce your taxes and then compound that wealth over time.
Now here's the interesting side of things, businesses, because something I need, something a lot of people who are going to be watching this podcast right now thinking, cool, I need to save tax. I need to save money, reduce my tax bill for my business. So I'm going to start with the very basic thing you just said there. Once again, let's just break down the different tax rates for businesses and also dividends. So let's go through that again. So you said it's the same rate, right?
Guys, today's sponsors here to revolutionize the financial game as we know it. So check this. TrustX Pay are firm believers that financial freedom should be accessible to everyone. They're a team of passionate innovators, technologists, and financial experts committed to revolutionizing how people control their money. Their platform allows you to purchase over 30 popular coins, including Bitcoin, Ethereum, Ripple, and other emerging cryptocurrencies, all possible in just a few taps. And with AI monitoring crypto prices, TrustX Pay ensures that you get the best rates for your transactions. They truly simplify crypto investments, making your financial management easy. And with a Visa card that's truly global, it's very simple. TXP users earn rewards with every transaction by earning TXP credits. And you can choose to redeem them rewards in either gold, silver, Bitcoin, or even carbon credits to help the environment. And here's where TXP solves a big problem that we all face. In an era of economic uncertainty, how do you protect the value of your money? Well, TrustX Pay user can safeguard their wealth by storing in various assets or commodities. They offer a revolutionary way to protect your future. Your funds are fully insured with their network of insurance providers, offering personal protection up to $150 million. Guys, there are so many benefits to TrustX Pay which I can't even list right now, so make sure you head on their website. You can check it all out for yourself. Use the code on the screen right now or the link in the description to get the discount that I made sure to provide for you guys.
It's the same rate, right?
Same rate. So let's say you're a self-employed individual who's not yet got a limited company. You're just acting as self-employed. So someone's paying you into a personal account or a sole trader account. It follows the same rates as employment does.
Okay.
20%, 40%, 45%, and you still get that tax-free allowance.
Yeah.
However, you do have to pay Class 2 national insurance and Class 4 national insurance. So there's additional NI to pay, but there is with employees as well.
Didn't you post something on your Instagram recently where it goes up to 60% now?
Yeah, so that's interesting. So when you get above £100,000 in income, for every
Personal income.
for every £2 that you earn, you lose £1 of your personal tax-free allowance. So essentially, there's a bracket of income where your tax rate goes up to 62%, including NI. So it's called abatement. You essentially abate your personal allowance, so you no longer have that personal allowance. So the 20% tax relief you got on that initial bit of income, you start paying, as well as still paying the 40% because it's at that rate. And then at that point in time, national insurance drops down to 2%. So you've essentially got 62% in taxes.
So as an accountant, I know you got to keep things professional, but essentially we're getting shafted left, right, centre.
No comment.
Fair enough. Okay, but for businesses, just for businesses to understand, they may be new to business as well. What are dividends exactly?
Dividends is, so you've got to imagine limited companies a separate entity to yourself,
Yep.
which essentially means Josh Thomas as the individual, Josh Thomas Limited as the company, separate entity. So Josh Thomas Limited is going to receive the income, have expenses, and then is going to have a profit. That profit goes to what's called your shareholders' funds or retained earnings. So essentially, let's break down an example. Let's say 100k in income, like turnover into the business.
Yep.
50k of expenses, 50k profit.
Yep.
You pay tax at 19% on that. Then what's left goes into your retained earnings. Then you can distribute that retained earnings to the shareholders of the business as a dividend. So it's essentially a distribution of profits.
So your tax bill is on the profits of the business.
So there's two points in time that you tax. There's corporation tax in the business
Yep.
on the profits. Then the post-tax profits that sit in your retained earnings, which essentially is like the amount that you can take out as the director.
Yep.
You can then withdraw that personally, and then you also pay personal dividend taxation on it. So there's two taxation points.
So that's your personal tax and then the corporation tax as well. Okay, cool. Now, let's just say business is earning over £100,000, right? Profits are, let's just say they got 90% profit margins. They haven't really got much expenses. You know, they're paying for maybe rent on a building, and they're a sole person. But they're not a self-employed. They've set up a limited company. They've put the structure in place for that. Now, what do they do in terms of reducing their tax bill? Because, you know, they want to incentivize as much as possible. They don't want to show HMRC that they're earning £90,000 profit.
Yep.
So what can we do about that to make sure that that tax bill is reduced down heavily?
So straight away, I'm looking at what do they need out of the business personally? Like what personal income do they need to withdraw? Because that's gonna change the levers that are available. We'd be looking at getting them on a director's salary straight away.
Yep.
So they take the 12,570 as an employment salary.
That's 0%.
Correct. 0% personally. and it's tax deductible in the company. So let's say they're paying corporation tax at a rate of 20%, let's round it off, 12,570, 20% of that, so nearly $2,500, you're going to save in tax just by setting up that in the correct way.
Okay.
So first off, make sure your director salary is set up efficiently. Then you've got to look at, right, well, what income do they need out of the company?
But can I just get my phone? I want to use a calculator for this as well.
Yeah, of course.
Right. So as I said, 100K. Yeah. They're making 90 grand profit. So we'll start off at 90. So you're saying basically deduct 12,570
Correct.
from that. So that leaves us with 77,430. So that's already brought the business profits down.
Yeah.
And then what's 20% of, you said 20% or something of the salary?
So corporation tax used to just be a flat rate of 19%. However, it's now changed. It's on like a marginal rate from 19 to 25%. But depending on what your profit levels are, you'll pay an increasing rate up to 250k in profits. So let's just assume for this example that they're paying 20%, just to make it nice and easy.
Yeah.
So 90k profits, we've put director salary in place. They're now earning 77, like you said. They're going to pay 20% on that. However, we now look at, right, what else is available to us in terms of levers to reduce profits and reduce taxation.
So just to put it as an example right now, if we was to pay 20% on that, the remainder, which was 77,430, I think it was, that tax bill would be 15,486. But what we want to do is see what else we can do out of that 77,000 to, see what else we can reduce off of that.
Correct. Okay, so there's quite a few things we can look at here. So first thing, like low-hanging fruit, where are they working from? Is there any use of their home for work? Because essentially, if they're using their home office for work purposes, their business is benefiting from something that it's not currently having to pay for. So there's 3 ways to do this. You can either claim an allowance, which is £6 a week. So let's say across the year, £312, which again, you can reduce profits by, so minimal amount. Or you can actually calculate how much is the household costing that individual, break it down into the different rooms that are used for business use, and essentially you can proportion the overall cost of the household and then charge it to the business. So again, you can reduce tax by essentially bringing profits down.
So it's almost like charging rent of that room to the business.
Yeah, you've got to make sure there's like non-exclusivity, so there's no capital gains issues. So there's a few boxes you need to tick, but I'll just give you the baseline. But yeah, you might be able to bring your profits down by another £3,000, £4,000, £5,000, depending on where you live in and what your household costs are.
I was going to say, so this may sound silly, but those rates of the rent, can anyone just make it up? Say, okay, I'm going to charge my business £10,000 a month for this room.
So it's got to be market rate. Okay. So it's got to be deemed reasonable by HMRC. So the way to do it so it's accurate and not just finger in the air is essentially look at what, as an individual, you're personally paying for the property. Let's say you use 1/6 of the property for your home working space. Then we'd look to proportion 1/6 of the costs. Like there's some extra complexities, but let's say that your house costs you 60 grand a year. Very expensive house. You break it down by 1/6, you claim 10 grand per year expense essentially. Okay,
fair play. So then what other ways are there? Because I still don't want to pay 20% on this 77,430.
No.
That's a lot of money.
Definitely don't. So next we're going to look at, right, what vehicle is that individual driving? Is there a reason that they need to pay for a vehicle personally, or can they get a vehicle through the company? Now, there's limitations on this. You have to either get a hybrid vehicle or an electric vehicle.
That's 100% tax deductible, right?
Correct. Yeah, we can get the cost 100%. Well, depends on, you have to tick a few boxes, but let's say you go for a fully electric vehicle, Porsche Taycan or a Tesla model, whatever it may be, you can essentially write off the cost of that vehicle against profits in year, providing it's a new car and the CO2 emissions are correct. So that's another option to reduce taxation. Let's say you go and buy a car for 30, 40 grand and you can write off that full amount. It's bringing it down by a lot.
But you can't buy a used car.
You can buy a used car, but then you can't claim 100% of the cost in the year of purchase. You've got to spread it over a certain period of time.
Okay, so go on.
That's what's called then a capital allowance. So you can either claim 18% of the cost per year or 6% of the cost per year, depending on what the CO2 emissions of the vehicle are.
Okay, because I was going to say, just to give an example, the price and the value of a Porsche Taycan has tanked purely because, business owners were buying them to write off on their business. Now, a lot of them they're done with them. They put them all in the market. So there's like 500-600 Porsche Taycans in the market. They're plummeted. They're around £40,000 that you can get them for.
Yeah.
Me looking at a new business owner, I'm thinking, all right, that's a good deal, you know, and it's electric. And I heard I can get this off my tax bill. But for it to be 100%, I have to get it brand new at 100 grand or whatever the case is.
Yeah.
And if I was to buy it used, then it would be 18 or 6% depending on the CO2. But if it's electric, then there is no CO2. Or
no, if it's fully electric, there's no CO2. So you'd be able to, let's say this example, you get a used Taken, you'd be able to claim 18% of the cost per year for that Taken.
Okay.
So let's say you have it for 5 years, you're still getting near to the full value, but it's just spread over a period of time.
Okay, so you can have it as long as you want.
Correct. It's called first year allowance. So if you qualify for first year allowance, you can offset the full cost of the vehicle in the year of purchase. If it's not qualifying for first year allowance, you've got to go 18%. And if the CO2 emissions are high on the vehicle, then you've got to go in special rate, which is 6%.
So I know there's, if we're along the lines of vehicles right now, I know there's other vehicles that can be done as well as a tax write-off, other than the electric ones.
Correct.
Would you be able to explain a bit about that?
This episode is sponsored by Fireaway Pizza, the fastest growing pizza company in the UK. With over 100 locations, you definitely have a store near you. The founder of Fireaway was on the show not too long ago, and you can get a slice of the action by using the discount code CEOCAST at fireaway.co.uk. Once again, use the discount code CEOCAST at fireaway.co.uk.
Of course, so the vehicle is deemed to be commercial,
Yep.
which, like a Ford Ranger, for example, monster truck, that's deemed to be a commercial vehicle.
They're to do with weight load, right? Or something?
Correct, yeah, payload delivery. If you buy a van, you're in construction, offset the full cost of the vehicle, there's no considerations. So it's got to be deemed commercial. However, you've got to have a business that is going to have a justification for buying that commercial vehicle.
Okay, so you can't be in social media and buy a van because I'm now a builder. Okay.
It's got to be reasonable, yeah. I mean, you can, but if you got inquired into, then they'd be like, you bought this vehicle, where's the wholly and exclusively for the purpose of the trade, which is one of HMRC's tests.
Yep.
That doesn't pass because you don't do any driving apart from personal driving, so you can't have that vehicle essentially.
And but because I know, I was speaking to, I done a podcast with Urban Automotive. Now, people who are buying G-Wagons, Land Rover Defenders, Lamborghini Uruses, the cars over that payload can also be written off as a tax write-off, right? Am I correct in saying that? Or
some circumstances, yeah.
Okay, so what's the circumstances in that?
So there's two parts to this. So you for one, if there's personal availability of use of the vehicle available for the director, then there's what's called a benefit in kind, which essentially means you're getting a benefit from the business. So then you have to pay the benefit in kind rate of that vehicle. So I did an example actually on a video the other day. So
The Lamborghini Aventador.
Lamborghini Aventador, 300k list price. You can claim the car as a cost in the business, but it falls into the 6% special rate pool. So 6% of 300 grand is 18,000 per year.
Yep.
You can claim as an expense, of which you'll get tax relief at whatever rate you pay.
It was 6% because of the CO2.
Correct.
Yep.
So let's say 300 grand car, 6% per year, 18 grand expense. Let's say we're getting tax relief at 20% on that. So you say £3,600 in tax that year for a car that's 300 grand. Then because it's available for the use of the personal of the director, you've got to pay benefit in kind. Now this is testing me. The percentage of a Lamborghini Aventador is 38% benefit in kind rate, which of 300 grand would be £114,000. You've then got to pay that as a benefit on your personal tax return, and if you're already a high rate taxpayer, which you probably are if you're buying a Lamborghini Aventador, you'd have to pay 40% on that plus NI. Probably cost you about 57 grand a year to buy a Lamborghini Aventador per year after the savings.
So when you say it will cost you, you're not really saving any in tax there.
Costing you 57 grand. So you can't do it essentially.
Yeah. Damn, that don't make sense there.
No.
Because I was watching a video last night of, you familiar with Yanamais?
Yeah.
He bought a new Lamborghini, I believe it was 558,000. So basically exact same ethos applies to that, to this right here.
Correct.
Okay.
The only real extreme scenarios that I've seen where you can write off a vehicle of that level is AU Vodka, for example. They bought Gold Lamborghini because that's part of their branding. And they record this like very, very detailed, and they only use it to literally sit there and attract sort of brand identity and attract.
So they're not paying
customers.
benefit in kind on it.
Because there's no availability of use, because it's literally just one event, next event, next event, next event. So in that scenario, it can be deemed wholly and exclusively for the purpose of the trade, which in a used vodka case is selling vodka, so they can claim the expense.
But question, how do HMRC know when you're using a vehicle when you don't? You know, we can put down the fact that we're not actually using it and therefore we don't have to pay benefit in kind, but how do they actually know?
They don't, but they will assume.
Mm.
So it's almost guilty unless proven innocent, which is the case with most tax investigations. They will assume that you've done wrong and you've got to then prove that you've not.
Yeah.
With a situation where you've got a Lamborghini and you tried to claim it as an offset, they're going to assume that you're using it personally, even if you're not.
Okay, so I think with this business that we've used as an example of, you know, turning over 100k, profiting 90k, buying a Lamborghini or buying a car like that just wouldn't make sense.
No.
It's not an option just to say, you as a tax advisor and accountant, to say, do you know what, Raheem, go and buy a Lamborghini. Mm-hmm. But I'm sure there are different suggestions then.
Of course. So let's say that individual currently is driving a Mercedes-Benz and they bought it personally, it's petrol or diesel. And let's say that they're open to buying a Tesla Model S or whatever it may be.
As well, or?
Instead of.
Okay.
Instead of. So they could essentially sell the Mercedes-Benz, pull some capital personally, put that into the business via director's loan, or they can just keep that money personally and then the business pays for it. And then whatever that expense of that new vehicle is, they can offset it against taxes. They don't have to withdraw money out now to pay for a personal car that they own personally. So they save on personal tax, they save on corporate tax, and the company essentially has a lower profit, so they can reduce the amount of tax they've got to pay.
Okay.
So that's a scenario where it does work.
Yeah. No, fair enough. I'm just trying to think of different ways we can actually, spend more money. And we were just speaking about this off camera as well, yeah. So we'll get into more tax saving methods in a minute. But for the people who are thinking right now, do you know what, I'm fed up of this UK country, I'm fed up of the tax rates, I don't want to pay it anymore, I'm going to go to a country like Dubai.
Yeah.
I sound like myself describing myself there. But how does this all work then? Going to Dubai, paying 0% tax is what we are told all the time over in Dubai. How does that all work then?
So there's two parts to it. There's actually setting up a company in Dubai, which can operate in Dubai and operate under the Dubai tax system. And then there's also your personal tax residency. So quite a lot of people shout on social media about how they've got this entity in Dubai, but they live in the UK. And they assume that then they're going to have to pay no tax. Whereas that's not the case.
Because in the UK.
Correct. Because you're still a personal tax resident in the UK. So the UK is still going to tax you on your worldwide income. Mm-hmm. So if you're pulling money out of your Dubai company, you then got to pay tax on it at the usual rates in the UK. Mm-hmm. So it's not as sunshine and roses as people make out, unless you're willing to relocate to Dubai, which a lot of people are doing these days, and essentially have your tax residency in the UAE, as well as your corporate entity in the UAE. Then you can benefit from all the tax rates that Dubai has, the tax benefits, incentives, etc. However, if you then come back to the UK and stay over a certain period of time, depending on all the different ties you have, the UK can then pull you back in as a tax resident and tax you on your overseas income again. So you've got to essentially dodge bullets to make sure that you don't pass residency tests and automatically become a UK tax resident. So providing you're willing to upshift your life and relocate, that is an option to save a lot of tax, build a lot of wealth, compound whatever you're doing in business a lot quicker. But you've got to be willing to make that move, and not a lot of people are, especially when they've got a family.
Okay, so question. I know, because I set up a company in Dubai, I know that it's 9% corporation tax, and I believe it's 5% VAT when you earn over 100, the equivalent of £100,000 profit, which is about 385,000 dirhams, I think it is, right? Now, what if, I'm not a tax resident in Dubai, I'm still a tax resident here. However, what I earn in Dubai, what my Dubai company earns is still in Dubai, and I haven't taken it out. Mm-hmm. And it's still in Dubai's economy system. It's in their banks, as their company. What about that?
Providing it's like a separate entity from you personally, and it's actually a company, you register it in the right way, then you haven't withdrawn that money personally. So you haven't taken any personal income. so it's not going to then be taxed in the UK. So you've essentially got a company that's compounding, reserves, capital's building, but you're not taking personal income, then that can be a setup that doesn't work.
And I'm trying to think about ways without, because I know a few people who do this, but I'm not going to say what or anything like that. You have a company set up in Dubai. You're happy to pay the 9% corporation tax. You're happy to pay the 5% VAT, whatever the case is. Yeah, cool.
Mm-hmm.
Then you're still here, tax resident in the UK. Now, I know what a lot of people do is that they invoice their company from Dubai to the UK company for expenses such as IP or expenses such as production, marketing, whatever the case is.
Yeah.
But they're both owned by the same individual.
Mm-hmm.
What's the logistics with that in terms of tax, and how's this all working?
So, great way to reduce tax, because you're essentially increasing expenses in the UK entity, which means your profits come down, which means you pay less. You've got to have a commercially justifiable reason to do that. If HMRC were to inquire and go, expenses have risen up, we see that it's consulting or IP to a company in the UAE, what's the commercial reason for this? And you can give an argument that stands on its own 2 feet, that there's a reason that you're doing that and it's benefiting the UK entity, and there's a reason that it's set up like that, fine. It's not an issue. A lot of people do that. Like, there may be, like, one example, we know someone who's got a podcast in Dubai, for example, and a lot of leads that go to the UK company come from the podcast in Dubai. So he essentially charges the UK company for content production, lead generation.
Is this a real example?
Yeah.
I feel like I know exactly what you're talking about.
Probably do. But yeah, that's a real example that you can do. And that's commercially justifiable reason. If you're just two companies and you're charging consulting between yourself, and a company in the UK, you're essentially just passing income across jurisdictions to benefit from a lower tax rate. HMRC probably won't like that.
So in this case here, if HMRC, which they probably will know that you own both entities or you have involvement in both entities of the UK company and the Dubai company, though they know that, and these invoices are being produced from the Dubai entity to the UK entity, can they not get involved and be like, hold on, hang on, I know exactly what you're doing here. You stop it right now, or we're going to give you a tax bill or put you in prison or something like that. Can they not do anything about it?
Yeah, they can. If you're still a UK tax resident and you've still got an entity in the UK and they believe that there's expenditure from a Dubai entity that you own, and the only reason that expenditure's there is to reduce tax in the UK, they can piece all of that together, and they can hit you with fines, penalties, etc.
So would you say the best way to do it, I'm not saying to do it, I'm saying I feel like we've got to be so careful in this podcast as well.
Yeah.
But I feel like if someone else owned the entity in Dubai, maybe a shell company or maybe a company of a company owns that company, and then they're invoicing you for whatever reason, like you've got nothing to do with it here in the UK, but you're getting charged with expenses. Would that be a better way to do it? Or
yeah, like, as long as it's commercially justifiable, as long as you've got a reason for it, and it's a genuine business reason that setup originates from Dubai and it's being charged to the UK company, then it's not an issue. Like, with this, like, I always say, you've got to speak to a tax advisor who understands your personal situation in the UK, the situation in the Dubai and overseas tax rules, can piece all of that together and actually put something in front of you that's tangible, works in the UK and the UAE. You get quite a lot of these companies that are just UAE. So they know how to set up a company in Dubai. They don't tell you about the UK side because that's the drawback.
Yeah.
That's the bit that's just going to put you off paying them 20k to set up a company in Dubai.
Yeah.
They don't tell you about that. So these people go, well, I spoke to this advisor and he set up a company in Dubai and it doesn't matter in the UK anymore. But
really and truly, it's not the case.
yeah,
Yeah.
you've got to have the right setup on both sides or it doesn't work.
Yeah. So really and truly, the best scenario possible to do it is just become a tax resident of Dubai.
Tax resident of Dubai, or you compound wealth in Dubai and don't take it personally.
Yeah.
Then you maybe live off investment properties in the UK or other income in the UK, for example.
Yeah.
And then maybe over a prolonged period of time, you have some sort of strategy to either get funds out of Dubai or you want to move to Dubai and then buy a property, whatever that may be.
Yeah, fair enough. So, but aside from Dubai being a tax-free country, I've heard that I think it's Isle of Man
Yeah.
that is also tax-free.
So you've got
And that's locally as well.
Yeah, so you've got Jersey, Isle of Man, the British Virgin Islands, Monaco, Geneva, Panama. There's a lot of different tax
reason why I
havens.
say Isle of Man is because literally right next door to the UK.
Of course,
Closer to Manchester than us right now in London.
there's a lot of wealth there.
Well, in Isle of Man.
Yeah.
Do you think that's purely because of tax? And I can imagine a lot of UK people going out there and living there or registering there or something like that.
Yeah.
Okay.
Same thing applies. Like you've got to watch your personal tax because people can set up a company there, but then they still want to live in the UK. So you've got to make sure you watch your personal tax residency. But it's a lot closer than Dubai. If you've got family in the UK, then they can easily travel between different
and forth,
jurisdictions, or family can just travel over to the Isle of Man.
Yeah.
Whereas Dubai, limitations. Like Dubai, you've got to look at your personal tax residency, then you've got to look at how many days you spend in the UK, and then you've got to look if you have ties in the UK. So you might have a home in the UK. The UK would deem that as a tie. You might spend over 90 days. They deem that as a tie. You might have a business in the UK. They deem that as a tie. And when they stack these ties together, they'll automatically pull you in as a UK tax resident. So you've got to essentially navigate the battlefield to not be a UK tax resident. And that's the same across the board.
All right, let's come away from Dubai for a second and moving abroad, because there are some people might right now thinking, you know what, my business is in the UK. I don't want to go to Dubai. I want to stay here. I just want to reduce my tax bill as much as possible. So we talked about, essentially having an office at home, purchasing a vehicle. What other tax methods are there to reduce my tax bill?
So there's loads of smaller efficiencies that you can import, which your accountant should be doing anyway. So stuff like recharging mileage to your company, trivial benefits. You can invest in private pensions. These are all stuff that your accountant should know. It's part of the usual playbook. But as you're an entrepreneur, driving wealth, achieving this business structure that you've got mapped out, hopefully you've got a business plan at this point in time, you can then start to set up stuff like group structures, where you essentially have holding companies that own shares in your main trading business. And then you can start to set up property investment businesses, financial investment businesses, and you can essentially build your own structure that is tax efficient. You can claim group loss relief, a substantial shareholders exemption if you're selling businesses. The arena of tax efficiency dials up massively as you become a fast-paced entrepreneur that's essentially making more.
Oh, fair enough. So if we had to give an example here, so this figure that was on here right now was 77,430. Being you being a specialist accountant, what do you think realistically, let's just say for a business that is a restaurant, what do you think you'll be able to get that profit down to?
So let's say they've got a partner, for example, that does administration, bookkeeping, helps out. They might have someone else in the family that also does the same. They can pay them at market rate. Maybe that's £12,570.
Yeah, I saw you put this in Instagram as well, yeah.
Correct. So maybe that could reduce it by another 25k if they've got immediate family that are helping. If they purchase a vehicle or family member purchases a vehicle, they could potentially bring it down by another 15, 20k. If they're recharging the home like we discussed, another 3, 4, 5 grand. If they're charging mileage back to the company, further again. You can claim trivial benefits, more again. If you start going on alphabet share schemes or reinvesting back into the company, whether that's digital assets, SOPs, capital expenditure, whatever it may be, we can quite quickly bring that down to near zero in some circumstances. It really depends on the capital available, the business vehicle that they're in, and the goals and ambitions of the director. You essentially got to lay out the playing cards and go, right, what options are on the table there, and then deal your best hand with that.
Now, I know you're an accountant and you advise your clients as well, yeah? So let me ask you this. Would you advise someone to reduce their tax bill as much as possible to 0%? I know no one likes the idea of paying tax, but would you advise it? Would you advise your clients to say, listen, just pay some tax for X, Y, Z reasons? If so, what would those reasons be?
If you're planning on staying in the UK, you've got to deal with the UK tax system, which is high. There's ways to reduce, avoid, minimise, but you're never going to completely get rid of taxation. So if you've got a profit that's increasing year on year on year and your business is growing and growing and growing, unless you literally reinvest everything back into the business, or you're willing to deploy a lot of that capital into investments, whatever it may be, then you're going to have to pay some tax. Unless you're willing to relocate and go to a tax haven overseas, you're going to have to pay some tax. It's just part of being in the UK and being part of the UK tax system, essentially. You're going to have to pay tax unless you're willing to rinse the pot dry and keep reinvesting and keep spending. But that's when you can start to use your capital wisely and go, right, is there other entities, is there other businesses that I can buy, is there property investments that I can go into, is there financial investments? Because at the end of the day, we're probably in business to time freedom, location freedom, financial freedom, which to do any of these, you need wealth. And to build wealth, you need to make the right financial decisions, which paying tax to HMRC every year at the top rate isn't a smart financial decision. So it's a balance of having the right tax strategies to try and reduce tax as much as possible, not bending the rules so you're at risk, and also making sure that you're understanding that you're in the UK tax system, you've got to pay UK taxes. So you've got to balance it all, and you've got to pay what you owe at the end of the day.
So investing into assets such as property, you can buy under your company, or
so you can set up a group structure. So let's say I've got this. People miss this all the time. Let's say I've got a trading company, and year after year, funds are stacking up, and it's at the minute just stuck in the company. People don't want to take it out personally because then they've got to pay 33.75 or 39.35% dividend tax. So they let it stack up, probably in like a low interest current account that's paying them 1%. But straight away we'd be going, right, well, let's get you in a high interest account. Let's get you earning 5% interest on that, for example. And then let's set up a group structure so we can start to funnel this money up to a holding company, down to what's called an SPV, special purpose vehicle, probably for property investment. And let's start investing in properties so that can appreciate over time and you can start growing your balance sheet. But it's all remained within the structure. So there's no taxation points.
Okay.
Because we're using a holding company to essentially go, right, this holding company owns the shares in my main trading business. So I'm going to pay a dividend up to the holding company. Then I'm going to, from the holding company, because it also owns shares in this property investment business, I'm going to distribute down to this property investment business. And I'm going to start building property or buying property, whatever the investment strategy may be, Airbnb, R2R, whatever it is. And I can start utilizing capital that my other business is earning to essentially grow wealth without having to pay the huge personal tax rates that the UK impose on us. So that's a strategy that quite often we use with clients to build balance sheet, build net worth, but not pay it off to the taxman.
On the flip side of things, in the podcast we just done about your story and everything, we mentioned there that, you'd been running your business solely yourself for 12 months, right?
Yes.
You had the company set up, structured, everything in place?
Yes.
Company card?
Yes.
Now, this is what I know a lot of business owners do. I'm not saying you did at all. They live their life using their company card, so dinners, car insurance, rent, anything, you name it, they're just living it on the company card just because, it's an expense to them. Is that something that you can actually do?
So you can use your company card as much as you want, but then your accountant is going to determine whether that's a company expense or that's personal drawings, which is what you've probably heard of a director's loan account.
Yep.
It's essentially, it manages transactions between you and your business and determines whether you owe the company money or the company owes you money. And the way to reduce your director's loan balance if it's overdrawn, so you owe the company money, is either repay it or vote a dividend and clear it. So let's say you've spent 50k on the company card. 10k of that is business expenses that your accountant has allowed and ticked off. 40k is you going out to a nightclub and partying, or you've bought some trainers for yourself that were nothing to do with the business. It's not an allowable expense. Your accountant's going to move it to your director's loan account, which means that you owe the company back £40,000 in that example. And the way to then clear that, because you've got to clear it, is either repay it to the company or vote a dividend to clear it. If you vote a dividend, which is the usual route, you've then got 40 grand of earnings personally that you need to declare and pay tax on. So yes, you can use the company card as much as you want, but if you're not educated properly, you'll quite probably get a nasty surprise at year end when you've got a big personal tax bill.
So just to give a quick example, because we live in the day and age of social media. Now I do social media for a living. This phone I bought on my own personal name, on my own personal bank card, but I use it every single day for social media purposes, to run the podcast, to organize, guests like yourself. Would the business now owe me money because of this purchase right here?
Correct.
Okay.
So there's two things you can do. You can either claim a percentage of the business use of that phone. So let's say that's 80%, and essentially you charge that to your company. Your company owes it you back tax-free via your director's loan account, and then you get the expense in the company. Or you can actually introduce the asset into the limited company so it sits on the company balance sheet. So let's say all this equipment here you purchased personally as Raheem. However, CEOCAST use it as their podcast set. Let's say this equipment is worth £20,000. You could introduce that into the company as an expense. It would now sit on your balance sheet as fixtures and fittings or equipment. You could claim a tax write-off for the 20 grand, and the company would owe you that back personally because you've paid for it personally. So quite often directors will have a laptop, a phone, maybe some equipment that they purchase personally, the business uses, make sure you transfer it, get the tax offset, and have that amount back tax-free personally.
I'm going to come to a very, very interesting segment of this, right? Because I think this is going to be, I'm very interested to see where it goes because I've heard a lot and I want to know the truth of it as well. So as I said, we live in the day and age of social media. We have people like myself who exist. I'm not the biggest, I'm not trying to say that, but we have, we have our rappers, we have our content creators, all that sort of stuff, who claim, and I've seen clips online, that they can purchase things and write them off as, tax write-offs. For example, I remember I saw a clip of a rapper buying a chain, diamond chain, Cuban chain, whatever it was, and saying it's going to be a tax write-off because he's investing into their image and they want to portray that image of being successful and everything like that.
Yeah.
Is that allowed?
No.
Not at all?
No. Now, the US is different. So
This was a UK rapper.
Okay. So no, it's not allowed.
Really?
So there's a test which is called, there's two tests. There's wholly and exclusively for the purpose of a trade, which is the reason I've got this expense or purchased this thing is purely for the business. Then there's duality of purpose. So is that expense potentially benefiting me personally as much as it is benefiting the business as well? So for example, let's say you go and purchase a suit. That is deemed to be of personal benefit to you, that you could go and wear it at a wedding or a function that's personal, nothing to do with the business. So HMRC fail it on the duality of purpose test and say you can't claim it. It's
almost like benefit of kind with them. But instead of the cars, you're doing it with this.
Similar. Okay. So if you're investing in your image, it's got to be seen as wholly and exclusively for the purpose of the business and there to be no personal benefit for you. So as that UK rapper buys a chain, has it around his neck, he's going to benefit from abundance, feeling affluent, feeling good. He's probably going to wear it to personal events. He's probably going to wear it going seeing his mates. HMRC would go duality of purpose, and they'd disallow.
But then once again, not to argue it, but how can they determine that if they don't see him on a daily basis? Because he might only wear that chain for posting it on social media. It might be in a vault or something like that. And the second he needs to do an Instagram post, right, get the vault open, give me the chain, taking the picture, put it straight back in.
Yeah, so HMRC, quite clever. So they do something which is called essentially availability of personal use. So you don't even have to use it personally because they can't prove that. So they say, well, is it available for personal use? Which means, can you use it personally? Is it accessible?
Yeah.
Yeah. So if you can clearly demonstrate that that goes into a vault and it is not available for personal use, then there's potential to offset and claim the expense. However, if it's sat in your home property and you just say, well, I had it in a safe, they're just going to go, no, it's available for personal use, disallowed. Whereas if you actually get it stored professionally and you've got paperwork, then it opens up the realm of potential explanation to claim the expense, essentially.
I'm sure there's a way around it and stuff like that.
Of course, yeah. It's every situation treated differently. You've got to look at the individual. What's their situation? What are they using it for? What industry are they in? Okay, well, if that's the expense and that's the reason for it, then how can we work that back and make sure it's offset? But if I'm going to paint it with like one stroke of paint, it's a no, really. However, there's potential ways depending on the industry and the individual.
So I've heard on social media stars and influencers, content creators can pretty much tax write off anything because anything can be deemed as a tax write-off due to the fact that, they're investing in their image and all that sort of stuff. But what you're saying here right now is that's a whole load of baloney, basically. Interesting.
Yeah. In most scenarios. So like, let's say you're an OnlyFans model and you're buying fancy props, let's just say. Let's say that's the case. Then you can claim it because it's wholly and exclusively for the purpose of the trade. But it's only because it's an obscure situation. Whereas if I own a marketing agency and I say, well, I bought a Rolex because I look better on social media and people might buy from me, that's not wholly and exclusive and it's not duality of purpose. You're not passing the test, so you can't claim it. So if you're an influencer, then there's more scope to be able to claim stuff to increase your perception of your target audience. There's more you can do there as an influencer. Like you can probably go and pay to rent out a villa and do content shoots, and you can probably pay for quite a lot of the props with the content shoots, alcohol, all this sort of stuff. If you're hosting a party and an event and that's to launch a product, then you can claim for the expenses. However, you've got to look at the situation. You can't just go, I'm investing in my image, so I'm going to write it off. Well, why are you investing in your image? How is that benefiting the business? And is that something that we can tick off and actually argue to HMRC that this is the reason it's happened?
Going back to the, personal use stuff and, whether it be cars, chains, watches, whatever the case is, what if another company or another entity own that, and then of the days of your usage, you're being charged rent for that?
If that is purely for like a content shoot or a business event, then you would most likely be able to offset that. Okay. Because again, there's no availability of personal use. You rent in that. Like let's say I'm doing a content shoot and it's on luxury travel. So kind of business I want to claim for luxury travel. And I go and pay for a private yacht for the day. Or I go and pay for a private jet, for example. And that's where I shoot the content. That's a tax deductible expense because I've done it for a purpose that's for the trade or that's for the business. Whereas if I'm going on a private yacht and I'm there for a week and my partner's there and my friends are there, but I've just said, well, really it's business and we did a bit of content here and there, HMRC aren't stupid. They're just going to go, no. So you've got to define the reason, and it's got to be commercially justifiable for the business. So that's why when a business owner's coming to us and going, Josh, right, this is the scenario, this is the expense, how do we write this off? That's where we then start to go, right, this is the case surrounding that expense. We essentially then try and bulletproof it with reasons that it's wholly and exclusively for the trade. And if we deem it to not be, then we'll let the business owner know. But we'll do everything we can to make sure it's offset.
So question, how much of HMRC can they actually find out about this stuff?
So unless they actually inquire, then not too much, because they don't have access to your bank to just log in and check your transactions. They'd need to inquire into you to do that. However, if you're a VAT registered business and you're trying to reclaim VAT on expenses you shouldn't be, you're essentially submitting that information to HMRC. So they'll flag you up as someone who's potentially overclaiming. Like there's a few risk factors that they essentially label on businesses. And if you pass a few of them risk factors, you're deemed a high risk case. They'll put a tax investigation officer on you and he'll essentially be tasked with how can we pull tax back from this individual that they've potentially underpaid?
In any way, shape or form.
HMRC is like a business just like anyone else. Like they're trying to bring tax revenue in and they've got certain expenses to bring that tax revenue in. That expense for them might be putting a tax investigation officer on a business. They might pay that person £300-400 a day. So they want to make sure it's a safe bet to pull enough tax revenue back to pay for that individual, surplus, and bring that back into UK economy essentially. So they're going to look for the high-risk businesses, inquire into them, and then you best make sure that when they shake that tree initially, there isn't branches falling left, right, and centre. Because if there is, then it's full-scale investigation.
Check. Yeah, because I've heard of investigations, people being watched by HMRC, meaning, this investigator could be on Instagram looking at their life or could be just doing full thorough investigations via social media just to make sure whatever they've said is actually true when it comes to tax and stuff like that.
Like just imagine you're an influencer in the UK, you're all over social media, you've got fancy cars, fancy watches, but HMRC know that you haven't submitted a tax return and you don't earn anything. That straight away is something
you've got it down as unemployed. Yeah. So you need to make sure what you're portraying on social media actually matches what you're submitting to HMRC, because if on the off chance someone did check or look, which I don't know exactly how often HMRC are checking Instagram, but I assume that social media age, young entrepreneurs, influencers, they're active. Yeah, I can imagine. Yeah. Anything else to know about tax reductions, for businesses?
I would say, like, before you've got to look at how to reduce tax, you need to look at your business vehicle, your business plan, because that's a lot of scenarios where people just assume, right, I need to be tax efficient before they're actually making a lot of money. Like, you need to focus on your business first. So, like, reinvestment back into the business to compound over time is a great way to offset tax, grow your business, make more money in the future, that you can then start to invest in all these different investment schemes, properties, group structures, and then you can generate and build wealth over time. So don't always just look at how do I save tax by having this obscure scheme or this write-off, do this over here. Like, also have a look at what you can reinvest back into the business to get the highest return, because I'm sure if you watch videos of like Alex Hormozi, for example, people spend that much time trying to be tax efficient that they take time away from being efficient in the business, which is going to earn them more money than saving some tax.
Yeah.
So at first, look at your business plan, identify opportunities for growth, risk factors, what reinvestment back in the business is going to have the highest return. And then when you feel like your clarity and your vision on where you're going in your business is as optimal as possible, then you start going, right, well, what tax strategies can I use to make sure that the profits from this business is as low as possible? And that's when you look at group structures. That's when you look at offsetting everything that you can, using a good tax advisor who's going to look at your scenario, look at your business model, look at your goals, ambitions, and go, right, let's reverse engineer all of this to whatever your dream outcome is. And then let's make sure we've got the best tax strategy to surround this dream outcome and this business model so you pay the least amount possible, keep as much in your pocket as you can. And that's what we do. Like, someone will come to us and go, how can we save tax? And it's like, right, well, what's your business model first? Well, what do you actually want to achieve? How much personal income do you want? What lifestyle do you want to live? You've got to ask all them questions first before you go, this is how you save tax. Because if you're trying to solve what leaks out the bottom before you've essentially filled out the bucket and understood exactly where you're going, in my personal opinion, you're wasting your time. So establish your business model first, then make as much money as you can, reinvest where you can, and then you start on the tax strategies.
Inheritance tax.
Huge. Yeah, inheritance tax, I mean, essentially, HMRC are going to tax you at every point. They tax you when you purchase, they tax you when you sell, they tax you when you make money in your company, they tax you when you withdraw, they tax you when you die, they tax you when you sell an asset. They tax you at every point in time. So inheritance tax, there's structures that you can essentially hold assets outside of your estate, which doesn't make up the estate, which is then charged for inheritance tax purposes, essentially. So trusts, beneficiaries, gifting, assets or capital that you have to individuals within your family before you die, providing you last 7 years. That isn't then included within your estate. And having a more advanced structure to make sure that your wealth sits outside of your personal ownership can massively reduce the value of your estate and massively reduce inheritance tax.
Well, Josh, I think you're going to save a lot of people tax bills, and if anything, teach them the fact that focus on your business first and foremost, more than focusing on how to reduce your tax bill, because that takes a lot of time in itself.
Yeah,
and that should be left and done to people like yourself and your team.
Yeah.
So if people want to find you and want to save their tax bill, want to get the right accountant in place, how can they get hold of you?
Best place would be to go to Instagram, so joshthomas.accountant. Click in the bio, there's an inquiry link in there. It'll ask you some questions. You'll filter directly through to the team. We will then essentially look at business model, industry, revenue range, set out exactly what we feel you need, and give you the solutions to plug in anything you need for your business to make more money and save more money.
Sweet as. Well, guys, you heard it all there. If you want to look at saving your tax bill, make sure you get in touch with Josh. I'm going to leave all the links in the description below. Everything you need to get hold of him. And until then, I'll catch you on the next episode of CEOCAST. Peace.